Okay. Good morning, everyone. Uh, Welcome back to our second session and the last one on Ind AS 21. Okay, that is foreign currency transactions. Okay, the effect of foreign exchange rates. So now, in the last class, we had a couple of new points that we discussed. First one is what is a functional currency? We saw that. And after the functional currency, we had a look at presentation currency and foreign currency. So functional currency is the currency of that entity, is the currency which is influenced by the primary economic environment in which the entity operates. Okay, so the currency that determines sales, costs, etc. We saw that is what is your functional currency. Foreign currency is any currency other than the functional currency, and presentation currency is the currency in which you report your numbers. So these are the three types of currencies. It becomes very crucial because this is what drives your reporting. Okay, so that is the first part which we saw. Then we moved on to foreign currency transactions, where we saw how we translate the numbers which are denominated in foreign currency to the functional currency. So we saw monetary items, non-monetary items. Monetary items, they are translated at the closing rates, whereas non-monetary items are recorded on the date when the transaction was effected. At the same time, they have also given us the convenience that for the P&L items, you may use an average rate if the volatility is not too much in terms of currency differences. Okay, so that takes care of the foreign currency transactions. Okay, we did a couple of problems in that. Notably, what we did was see the usual assets, creditors, debtors, all of that we are fairly conversant with, but we saw two types of different problems. First one is revaluation of assets. So when there is a revaluation of asset, you have to do the you have to take that exchange rate which exists on the date the revaluation was done. So that is one new point which we did. We saw a question on that. At the same time, we also saw Ind AS 109 interplay with Ind AS 21. So you apply Ind AS 109 principles, that is the amortization cost principles for financial instruments, on the foreign currency, and that balance you will then convert to the functional currency using the principles of Ind AS 21. Okay, so this was what we had seen in the last class. Okay, you need any note for the Ind AS 109 conversion? Yes, we can just write a quick note and then we can proceed further. Okay, I think we had not written the note in the last class. So you can give the heading application of Ind AS 109, sorry, Ind AS 21 in amortized cost method of Ind AS 109. Please ask, Sanjay. Go ahead. Please ask. What is your difficulty? Really ask. Okay. All right. First one. The loan is a monetary item. The loan is a monetary item, and hence would be recorded at the closing rate at each balance sheet date. You remember this was what we had done. Okay. Second, the effective interest would be recorded at the average rate since interest accrues over the year or period. Third, coupon payments. In our example, that's 6 lakhs. Coupon payments would be at the rate on the date when the payment is made. Since it is an actual outflow. Okay, the money actually goes from the bank. So that is why we record the coupon payments at the rate on the date when the payment is made. Okay. Fourth, determine closing balance of the loan in foreign currency by preparing amortized cost table following principles of Ind AS 109. Okay. On applying Ind AS 21 principles outlined in steps 1 to 3 above to the components of the amortized table prepared in step 4, comma, a balancing figure may arise which represents Forex gain or loss. Okay, so this was what we had done. If you remember, you would if you are able to recollect, we had followed the same principles in the last class. Okay. Good morning, Ankur Handa. Good morning, Namaste, Sumit Jain. Good morning, Rashmi. Yes, Sanjay, what is your problem? You did not ask your problem. Okay. Good morning. Just tell me once you are done. Kaushiki is not attending. Manini, are you around? Yes. Okay. Soham, Shailendra, are you guys there? Yes. Done? Okay. Viraj, good morning. Yes. Okay. So once this is done, note it down, everyone. So now let us come back to our discussions. Okay. So we have completed our discussions on foreign currency, what you can say, operations. On foreign currency transactions, not operations. Okay. See, these are some additional questions which I had put in. Okay, so I want you to try them for homework. बहुत simple है, it's not at all difficult. Okay, the solutions of these questions, I will be sharing this sheet with you, not this one, sorry. I'll be sharing this sheet with you. It contains all the problems that is there in this presentation. Okay, which is fraught from the study module, the extra problems that I have put in. Everything is there in this particular PDF file, which I'll be sharing with you. Okay, so I want you guys to try these questions for homework. Okay, please do it. They are very simple and attemptable also. Okay, so I can focus on something that is new for us. Okay, coming next to foreign operations. So these are, what is a foreign operation? These are activities based or conducted in a country or currency other than those of the reporting entity. So take for example, you have a company H Limited Mumbai. So it is a company which is based in India. So the functional currency of H Limited is INR. Okay. Now it is quite possible that this H Limited would have a branch in London. So H Limited branch would be denominating its transactions in pounds. Okay. It could also be having a subsidiary. In Sydney. So there the currency is Australian dollar. So you have a subsidiary SPLC, which is incorporated in Sydney. It could be having a joint venture or a joint arrangement in Berlin, Germany, named as JLLC. So here your currency could be, for example, euro. And it could be having an associate in New York, AINC, where the currency is the US dollar. So these are some of the ways you could be structuring your foreign operations. It could be a branch, it could be a subsidiary, it could be an associate, or it could be a joint venture. Now, the important point is, at the end of the reporting period, when H Limited has to prepare its financial statements, if it has to prepare standalone H Limited, it will also have to include the results of the branch, that is the London branch of H Limited. So there, H Limited's trial balance, if you see, it will be in Great Britain's pound sterling. Okay, that would be the currency of the trial balance. Whereas H Limited's trial balance would be in the currency of INR. So now when I have to consolidate, obviously I cannot do a simple addition because the currencies are different. So I will have to convert H Limited's trial balance from pound sterling to the Indian rupee. If I have to prepare the consolidated balance sheet of H Limited, which I have to because I have a subsidiary as well, then I try to extract the trial balance of SPLC, which is my Australian subsidiary. That will have its figures coming in Australian dollars. So therefore, I will have to convert it to INR. Same applies for JLLC and same applies for AINC. So the principles that we are now discussing in today's class is how do I start the conversion of these trial balances into INR? Are there any principles? What are the rates at which the balances should be converted? And if there arises a balancing figure on account of such conversion, where do I take that? Do I take it in the P&L? Do I take it in other comprehensive income? What do I do with that? Okay. And suppose any of these foreign operations are disposed of, that is sold, then what do I do with that difference? So these are some of the things which we will be discussing in the session now. Okay. For the time being, don't pay attention to this net investment in foreign operation. I'll come to that towards the later part of the transaction, of the discussion. Okay. So now, how do I translate my foreign operations? How do I translate my foreign operations? So this is just a theoretical slide. Okay, what it tells is you can do a step-by-step method if there is no direct exchange rate. So suppose Indian rupee and Australian dollar, there is no direct exchange rate. Sorry, not that way, step-by-step method or direct method. So suppose you have a step-by-step holding, you can translate it from one currency to that of the intermediate parent and ultimately to the currency of the ultimate parent. Alternatively, you can convert it directly to that of the ultimate parent. This is just a theoretical understanding, बाकी इसका कोई relevance नहीं है. But what is important for us is how do I translate the foreign operations? कौन सा rate use करेंगे? So now we are dividing the trial balance into two parts: items which represent the financial position, that is the balance sheet items, and items which represent the results, that is the P&L items, that is the P&L items. So how do I record this? So how do I record this? Okay. So when I talk about my financial position, assets and liabilities are translated at the exchange rate at the reporting date. See, when they say assets and liabilities, are they differentiating between monetary and non-monetary? Answer is no, they are not differentiating. So basically, this includes monetary plus non-monetary, monetary plus non-monetary assets and liabilities. So you have the trial balance of the subsidiary or of the branch. That trial balance will contain balance sheet items. So the balance sheet items, assets and liabilities will be translated at the exchange rate on the reporting date. Okay, this is only assets and liabilities. I'm not talking about items forming part of equity and liabilities. Okay, I'm not talking about balance sheet items forming part of the equity and liabilities. We'll come to that later. This is only external assets and liabilities. Okay, external assets and liabilities. Okay, so this is what you will be doing. Okay, first one. Second one, we talk about the results, that is the P&L items. So incomes and expenses, you will translate at exchange rate at the date of the transaction. So this becomes your spot rate. This becomes your spot rate. Average rates may be used if exchange rates do not fluctuate significantly. So that is what we are always going to do. So this is how you will do the recording. Okay. Now coming to balances of equity share capital. Equity share capital, assuming it is a subsidiary. If it is a branch, the story gets over here. Branch is my own operations carried out elsewhere. So therefore, it will only have assets, liabilities, and income and expenditure items. Apart from that, nothing is there. So if it were a branch, we are done with it. Nothing else is to be recorded. Moving forward, if it is a subsidiary will have its own equity share capital, its own reserves and surplus. So how do I record that? So equity share capital of the subsidiary will be converted using the rate on the date of acquisition. Using the rate on the date of acquisition. You are having equity share capital of the subsidiary. Why are you consolidating? Because you have acquired the subsidiary. When you have acquired the subsidiary means what? You are having shares of the subsidiary. So therefore, the date when you have invested, the date when you made the acquisition, take the rate on that date to convert the equity share capital of the subsidiary into the functional currency of the parent. Now, when I talk about reserves, this is where your knowledge of consolidation comes into existence. This is where there are some issues. Okay, so post. So your pre-reserves represent the reserves which were already in existence when you acquired the subsidiary. So as the consolidation student that you are, as the business combination student that you are, tell me my pre-acquisition reserves. Does the parent or the acquirer purchase the pre-acquisition reserves, or does the parent or acquirer earn the pre-acquisition reserves? Understand my question carefully. Does the parent purchase the pre-acquisition reserves, or does the parent earn the pre-acquisition reserves? वो कमाता है कि खरीदता है? Does he buy the reserves or does he earn the reserves? So this is my question. You tell me, what do you do? Okay, because your answer will automatically give us which rate should be applied. Okay, come on, tell me. I'll address your query in a short while, Sanjay. Okay, just give me some time. Let me be done with this. Okay. I'll address it. Don't worry. Okay. Yes, tell me. Pre-acquisition reserves. You obviously purchase that reserves. You remember we used to do cost of control account, where we used to compare the investment with the equity share capital and pre-acquisition reserves to determine the goodwill or capital reserve arising on the acquisition. So if you are buying the reserve, that means you will apply which rate? The rate on the date of acquisition. The rate on the date of acquisition. Sir, equity jaise? हाँ, बिल्कुल. The same like equity share capital. So rate on the date of acquisition for equity share capital, rate on the date of acquisition for pre-acquisition reserves. Okay. Coming to post. Now these are the reserves which you are earning. These are the reserves which you are earning when you are controlling the operations of the subsidiary or of the branch. Okay, so now it's a subsidiary for us, so we'll talk in terms of that. So the post acquisition reserves are earned when you are controlling, and therefore you will translate using what? Average rate during post acquisition period. Average rate using post acquisition period. Is it okay? Yes. Are you convinced what rates need to be used? Yes. So subsidiary's trial balance is denominated in foreign currency. I have to convert it to functional currency, that is INR, for all practical purposes. So what am I going to do? Balance sheet items, translate using the closing rate. Sir, monetary, non-monetary differences, don't worry about that. Whatever is there, apply the closing rate and just do the conversion. What about your P&L items, sir? Ideally, incomes, expenses must be translated on the rate when they are actually arising. That means the rate on the date of the transaction. But if your currency is not very volatile, then you can use the average rates. What about equity share capital? You have invested. That means you have bought the shares, you've made the investment, you've acquired the control. So the rate on the date of acquisition. And reserves, well, you split into pre and post. Pre will be translated at the rate on the date of acquisition, whereas post reserves are earned by you when you are controlling the subsidiary. So you will apply the average rate during the post acquisition period. So once you do all this, आपके पास ट्रायल बैलेंस आ जाएगा in the functional currency, that is INR. Once you do all this, आपके पास trial balance will get converted. You will see figures in the trial balance for the Indian rupee, that is the functional currency. Now my question to you is, do you think the functional currency denominated converted trial balance will tally? Do you think the functional currency denominated trial balance that you have prepared on converting the foreign trial balance to the functional currency using the rates, do you think that will tally? Do you think that will tally? Yes. Do you think it will tally? This is not accounting. This is not accounting. This is just plain simple mathematics. Okay. You are converting a foreign trial balance into the functional currency using one rate for assets and liabilities, another rate for incomes and expenses, another rate for equity share capital and opening reserves, and another rate for post-acquisition reserves. So my question to you is a simple maths question. Do you think the trial balance will tally the converted trial balance? वो नहीं होगा tally. 99.9% वो नहीं होगा. सर 0.1% होता है ना, संयोग से टैली हो सकता है, आउट ऑफ कोइंसिडेंस इट में टैली, बट इन मोस्ट ऑफ द केसेस, मतलब practically all the cases, the trial balance is not going to tally. There will be a balancing figure. Okay, sir, why balancing figure? Array, you are converting a tallied trial balance to the functional currency using different rates. So I have two figures A and B tallied, but when I convert A and B to another figure, I'm not using the same rates for A, the same rates for B, and therefore the converted TB will not tally. There will be a difference. Where do I take this difference? Do I take it to the P&L? No, you do not take it to the P&L. You will take it in other comprehensive income. And in other comprehensive income, we recognize it as an FCTR. We recognize it as an FCTR, a foreign currency translation reserve, or we call it as a currency translation adjustment, or we call it as a currency translation adjustment. Okay, don't look at this part for now. अभी के लिए इसको छोड़ दो. Okay, net investment in foreign operations. For now, you forget this. Okay. What it is, I will explain towards the end of today's class. It's a very simple concept, but abhi ke liye isko bhul jao. So now you are having a foreign currency translation reserve. Okay. Why it arises? Because you are applying different exchange rates to different items in the trial balance of the subsidiary. Sir, why do you record it in foreign currency translation reserve and why not in the P&L? Sir, in all the cases, the foreign currency transactions that we had, we have always taken the exchange differences to the P&L. Why are you not taking this to the consolidated profit and loss is our question. The question is there in the case of foreign currency transactions. In the case of foreign currency transactions, that means export of goods and realization of proceeds from your debtors, import of goods and payments made to import creditors. In these cases, or foreign currency loan taken and repayment of the foreign currency loan. These are all foreign currency transactions. In these cases which I just now told you, there is an actual settlement of the asset and the liability. There is an actual settlement of the asset and liability at some point in the foreseeable future. आने वाले कुछ महीनों में, कुछ हफ्तों में, कुछ दिनों में इसका सेटलमेंट श्योरली होगा. सर, लोन तो फोरसीएबल फ्यूचर नहीं, इट विल बी, से इफ इट इज एन ईसीबी इट कुड बी 5 years 10 years, बट सेटल तो होगा. इट विल बी सेटल्ड, yes or no? Debtors, you will get the money, no, from them. Creditors, you will surely pay them. So there is a certainty about the settlement in the foreseeable future, and because there is a certainty about the settlement, we used to take the exchange differences into the profit and loss. We used to take the exchange differences into the profit and loss. However, if I have a foreign subsidiary, this foreign subsidiary is not going to get settled at any time in the foreseeable future. just because you want to you want to expand your exports, you will not set up a subsidiary. Okay, you will set up a subsidiary because you find that probably the economic policies there are suited, the tax regimes there are well suited. You will have a lot of cost savings there because of these operations. You could be having what you can say availability of resources more easily than what you are having here. It could be a very profitable venture to set up your entity there. So considering all these factors, when you make an investment in a foreign subsidiary or a foreign branch, whatever you call it, the intent is not to realize that in the foreseeable future. The intent is to earn the profits from that. And because the intent is not to realize that, we cannot put it in the profit and loss account. What the exchange differences that are accumulating. We will therefore have to record it in other comprehensive income through the foreign currency translation reserve. But sir, realization one case में हो सकता है. There can be a realization in one case. That is, sir, अगर मुझे अपना बोरा बिस्तरा बांध के वो subsidiary बेच देने का, I have to dispose of that foreign operation. I have to sell that foreign operation. If that is the case, then now when you are selling your foreign operation, you are ultimately realizing that amount. You are ultimately realizing that amount. That means what? All the exchange differences which you are accumulating on an annual basis, ultimately that will, and on the date when you are selling the subsidiary, when you are losing the control over the subsidiary, on that date, what are you going to do? You will reclassify the balances which are there in foreign currency translation reserve to the profit and loss. So FCTR is not a non-reclassifiable item. It is a reclassifiable item. When will I reclassify it? When I dispose of my foreign operation, when I sell off my foreign subsidiary, when I lose the control in the foreign subsidiary, that time, whatever gain or loss arises on that too will surely go in the P&L. Along with that, whatever balance is there in the foreign currency translation reserve, that will also go to the P&L, because now you have realized those foreign currency differences. Aapko paisa mil gaya, you got hard cash, and that is why FCTR will be moved to the profit and loss account as a realized item of income or loss, whatever it is. Okay, have you understood the translation of foreign operations? Yes. Have you understood? Have you understood? Bolo. Have you understood? Yes. All of this what I have discussed is there here. Okay, so don't worry, sir ne kya kaha, kya nahi. It's there. Everything is there. Okay, so all of this is clear. Okay, Rashmi, is it fine? Ankur, Handa, Viraj, Desai, Soham, if you have caught up with the session. Yes. Is it clear? Where is Kaushiki is not to be seen. Manini is not to be seen. Okay. All clear, everyone? Yes. Okay, so Rashmi has confirmed, Sanjay has confirmed, Ankur has confirmed. Okay, fine. So translation of foreign operations is done. Acha, but sir, there could be intra-group balances, like parent has given money to the subsidiary to be repaid back. Parent has sold goods to the subsidiary and I have to collect the money, or subsidiary has sold goods to the parent and parent has to make the payment to the subsidiary. So what I'm trying to say is there could be intra-group balances, which include a monetary asset or a liability, Okay. So now this is as per 110 principles. आपने देखा था when we did Ind AS 110, parent and subsidiary interbalances are getting eliminated in note 1 adjustment column. Sir, note 1 कौन सा था? Note 1 we used to prepare assets and liabilities of parent subsidiary adjustment total. In the adjustment column, we would eliminate the intercompany eliminations. So here also, we will do the same eliminations. You can see incorporation follows normal consolidation procedures. That means you will eliminate intra-group balances or transactions of a subsidiary. You will eliminate the intra-group balances of the subsidiary. Okay, we will be recycling that. Okay, I told you we will be taking it to the FCTR at the time of disposal. Until then it will be parked in the FCTR. Okay, coming to the next one, sir, suppose I am a parent. Okay, parent sells goods to its subsidiary. Parent is in India, so rupee is the currency, but it invoices its goods in the dollar. So in the parent's books, you will be having foreign currency receivable from the subsidiary. That is right. Now, Ind AS 21 principles, when P will start preparing its standalone financials, P will convert this receivable into INR using the closing rate. And whatever be the gain or loss, it takes it to the P&L because it is a translation gain or loss. So parent foreign currency receivable. Okay. Now when I am going to consolidate, just look at how the issue starts to look at. Okay. Parent in its balance sheet is having debtors. In the debtors, it is having S. Parent's balance sheet is rupees. It is having S $10 as receivable. Okay. Debtor. Exchange rate on the date of sale was how much? Let us assume it is 80. So this was 800 on the balance sheet date. Closing rate. This is 800. Closing rate is 85. So this becomes 850. So on the balance sheet date, S will appear at 850 and I will have a P&L of 50 rupees, which is my foreign currency translation gain, which I will record it in the profit and loss as per Ind AS 21 principles. Now, when I am going to consolidate, you remember the flow. I told you to revise and come. Note 1. I have parent subsidiary adjustment total. So here I will be having debtors. There will be some figure for P, and in creditors, when I translate using the principles, there will be some adjustment here. Okay. So now from both the places, I will eliminate 850. Because that is my intercompany balance. But when I come to the consolidated reserves, consolidated other equity, sir, ये कौन सा other equity है? This is working note 1 which I used to prepare. Okay, note 1 was assets and liabilities. Note 2 used to be your Note 2 used to be your equity share capital. Note 3 used to be your other equity. Below note 3, we used to have working note 1, consolidated other equity. In the consolidated other equity, we are having balance of P. It will start with this 50 included. It will start with this 50 also included there. Add share of S. You remember, this is what we used to do in the consolidation process. Okay, so 50 plus X. Okay, so now my question is, or what would be your question is, sir, do I include this 50, which is the translation gain on my subsidiary's intra-group balance? Do I take it or do I eliminate it? Okay, understand the question. This 50 arises on account of this conversion. On account of this conversion. This conversion is basically an intra-group balance, an intra-group balance. Okay. When I do the consolidation, I start with the balance of P. To that, I will add the share of the subsidiary. The balance of P will include the 50 rupees foreign currency gain which was taken to the P&L of P in its standalone financials. My question to you is, should this 50 continue or should it be eliminated? Should this 50 continue or should this 50 be eliminated? Think and give the answer. Think and give the answer. Should this 50, which is included in the reserves of the parent, the standalone reserves of the parent, should it continue or should I eliminate it? Okay. You just give me this answer. Eliminate hoga to kahan pe hoga, I will explain. If I don't eliminate it, why I am not eliminating, that also I will explain. Okay. Okay. तो अंकुर जी कह रहे हैं कि वो eliminate होना चाहिए. What about the others? Rashmi Kamath, what do you think? Viraj Desai, what do you think? Sanjay Pal, what do you think? Soham Bakre gave his answer. Okay. Who else is there? Yes. Who else? शैलेंद्र, आपको क्या लगता है? What do you think? What do you think? Shailendra is saying include it in the parent's P&L. Don't do any adjustment. Yes. Any other answers? Viraj, what is your answer? Sanjay, what is your answer? Sumit Jain is also there. He's saying eliminate. Okay. So we are having a lot of answers which are saying eliminate this 50. Will I eliminate this 50? The answer to that is no. हम इसे eliminate नहीं करेंगे. Sir, but group balances we are eliminating. No, absolutely right. I am eliminating 850. There is no second thought about it. Why I will not eliminate this 50 is because this 50 represents the exposure that the group is having to foreign currency fluctuations. Ye 50, see, if I have a gain of 50 rupees today on account of translation, it is the benefit of the group to the foreign currency fluctuations that happen outside. Suppose if this 50 were to be a loss of 40, that would represent the group's risk. It is carrying that risk in its balance sheet by holding the intra-group movement, by holding the intra-group balances. It is a risk to the group as a whole. Doesn't matter whether it's in the parent or with the subsidiary. What is important to notice, this 50 rupees foreign currency gain or loss, whatever it is, it represents, or it is a representation of the risk that not only the parent has, but the group also is exposed to. And therefore, this 50 we are not going to eliminate. It will continue to remain in the P&L as it is. It will continue to remain in the P&L as it is. So coming to exchange differences on intra-group monetary asset or liability, the monetary item represents a commitment to convert one currency to another. It is a commitment to convert. And what does it do? It exposes the reporting entity to currency fluctuations. It is a representation of currency fluctuations. Currency fluctuation for the group as a whole also, not only the parent, for the group as a whole. So intra-group monetary asset, whether long-term or short-term, cannot be eliminated without showing the results of currency fluctuations. Cannot be eliminated without showing the results of currency fluctuations. So यहाँ पे many students will automatically think intra-group है ना, हम 50 को भी eliminate कर देंगे. If you eliminate 50, what happens is, first one, you are not giving a proper picture. You are not giving a proper picture. Why, sir? Because you are hiding the fact that you as a group are exposed to foreign currency fluctuations. Sir, where am I hiding the fact? Why am I exposed? अपना ही balance है ना? Balance आपका है. It is the balance between the parent and the subsidiary. But tomorrow, when the subsidiary goes to the bank to settle this dues, he will pay, let us assume, $10 in our example. He will pay $10. In your books, will you get 10 into 80, 800? No, it could be 850, it could be 750, it could be 780, it could be 810, कुछ भी हो सकता है. Depending on the rate that is prevailing on the date when the subsidiary decides to settle that. That means whether you are intercompany or not doesn't matter. The foreign currency exposure is a totally different exposure which does not get impacted due to intra-group relations. And that is why we are not going to eliminate it. We are not going to eliminate it. Okay, so I hope that this is clear. Exchange differences will not be eliminated, but intra-group balances or transactions will definitely be eliminated. अरे समझ में आ गया अपने को? Yes. Have you understood this? Why we will not eliminate? Yes. Bolo. Please tell me. Have you understood? Yes. Everyone. Soham. I am coming to that FCTR part later on. Okay. This one will be in the P&L. This one will be in the P&L, in the profit and loss account. Okay, all clear? Rashmi, Soham, got it? Okay, fine, great. Ankur, आपको समझ में आ गया वो eliminate क्यों नहीं होगा? Viraj, did you follow? Sanjay Pal, did you follow? Yes. Okay, great. So that takes care of this part. Yes. Moving on. Okay, fine. So we have done the basic for solving a question. Okay, question के लिए जो चाहिए हमने वो कर दिया है. Let us look at a question on this. Okay, it's just plain multiplications and revisiting the concept. Okay, so I will take you straight away through the question and the solutions. Okay, 1 second. Okay, fine. Okay. This is taken from Test Your Knowledge. Okay, but it has come in one of the exams also, or RTPs also. Okay, all right. Infotech Global Limited has a functional currency of USD and needs to translate its financial statements into the functional and presentation currency of Infotech INC, which is $. The following balances appear in the books of Infotech Global. You are having issued capital, opening retained earnings, profit for the year, accounts payable and accrued liabilities. property, plant and equipment, and receivables. Okay, so this is the US dollar. Translate the above balances of Infotech Global into L dollar, ready for consolidation by Infotech Inc. Share capital and opening retained earnings are to be taken at this figures, that is L dollar 30,055 and 15,274. Okay, respectively. Prepare a working of the cumulative balance of the foreign currency translation reserve. Okay. Relevant exchange rates of the year per L dollar are as follows. Rate at beginning of the year, opening rate 1.22, average rate 1.175, rate at the end of the year is 1.13. Okay. So when I translate, let us first record all assets 50,000, 9,35,000. Okay. Then liabilities 50, 28, 20, 8, 40, 47. 50, 28, 20, 8, 40, 47. Okay. The rates are given. All assets and liabilities will be translated at the closing rate. Closing rate is how much? 1.13. So here I am having 1, 2, 3, 4. Okay. So 1.13. So 1.13 I convert using the L dollar rate which is given. So that gives you these balances. Okay. It's just a multiplication division. That's it. Nothing else. No rocket science. They have given us share capital and opening retained earnings are to be taken at these values respectively. So share capital, this one, retained earnings, opening, this one. Okay, 15,274. Now coming to the next one, profit for the year. This is earned when I am in the control. So therefore we take the average rate of 1.175. So that is 17,021. When I balance out this, it comes to a balancing figure of 24,376. 24,376. This represents a foreign currency translation reserve. Why this reserve? Because it is arising on account of translation of the balance sheet of the subsidiary into that of the functional currency of the parent. So it is known as an FCTR. It is known as an FCTR. Okay. What exactly this FCTR is made of? What exactly is it made of? It's made of only two things. One is opening share capital. The other is reserves. Reserves bifurcated into pre-acquisition and post-acquisition. That's it. Nothing else. Okay. So, because remaining external assets and liabilities are all converted using closing rates. So FCTR obviously will not arise on those items. FCTR arises only on equity items. So therefore, this 50, 28 and 20, if I convert using the closing rate, I will be getting these balances 44,248, 24,779 and 17,699. But currently what is the exchange amounts? What is the translated amounts I have taken? This is what is given 30,055, 15,274 and this is the 17,221 which I have taken here. So because of this I am getting these differences, which is exactly equal to the FCTR that I have recognized as a balancing figure, which is exactly equal to the FCTR that I have recognized in the yes. PPE is not under revaluation model. यहाँ पे तो कुछ लिखा नहीं है. So we will be doing the closing rates. Okay, we will be doing the closing rates. All right. You are translating a foreign subsidiary, a foreign operation into the functional currency of the parent, and you will therefore have to take the closing rates. Okay. All right. Is it done? Have you understood 24,376? Yes. Have you understood this part? Bolo. Did you understand? Yes. Any difficulties here? See, you will be in a position. It's just a simple calculation, nothing else. Okay. Got a new voice, Param. Okay. Param ko samajh mein aa gaya. What about the others? Rashmi, Firaj, समझा आपको? Yes. All right. Ankur also got it. Okay. All right. Coming to the next question. See, the same question has come in your May 2019 exam also. Okay. Same question, same format, same data, same thing. They have given share capital, opening retained earnings are to be taken at this respectively. So, bus you do that and you are going to get similar answers. That's it. This had come for how many marks? Question 3C. I think for 8 marks probably. Okay, 6 or 8 marks. Okay. So please go through that. Okay. All right. Have you guys understood this? Yes, all of you have understood. You have confirmed. Okay. All right. Now, okay. So FCTR is done. Intra-group balances is what we will now look into. Okay. Is what we will now look into. Okay. Fine. And then we will wind up with a question on okay. This is what we did just now. This is also what we have discussed. Okay. All right. Okay. Great. So that takes care of this part. Chalo. Let us proceed with. Yes, it's very simple. Okay. मतलब ऐसे question आते हैं ना तो टूट पड़ने का in the first 8 to 10 minutes and get your marks assured. Okay. All right. So now let us start with the other part, that is intra-group balances. Intra-group balances जो है, how do we do the adjustment for that? How do we do the adjustment for that? Okay. 1 second. All right. Do I do a question first or how to make you understand? I want to do a question first, or do we do something else first? Okay. Okay, fine. We'll do the small questions first quickly, and then we shall look at the other items. Okay. All right, fine. So now let us come back. Parent P has USD as its functional currency. Subsidiary S has Euro as its functional currency. P, whose reporting date is 31st March. P, whose reporting date is 31st March, lends $100 to S on 30th September 20x1. S converted the loan amount received into euros on the date of receipt. Exchange rate at 30th September, $1 equals 1.5 euros, and exchange rate at 31st March, $1 equals to rupees 2. Pass the journal entries in the books of S as well as of P. Okay, so we will have to do this question. So first one is I'll do it here only because it's fairly simple. Books of S. Books of S. What entry it will pass? Bank account debit to intra-group loan. This will be $100 into 1.5. So 150 and 150. Okay. Next, closing date. There is a movement in the balance. There is a movement in the balance which gives rise to an exchange loss. It is adverse to intra-group loan, 50-50. So you will be recording this at 50 and 50. What about the parent? What about the parent? Parent will just pass intra-group loan debit to bank 100. It will pass the entry at 100. This is euros, whereas this is in dollars. This is in dollars. Okay. On consolidation, 100 will get eliminated. On consolidation, intra-group balances will get eliminated, whereas the exchange loss that is there, that will continue to remain. Is it okay? Yes. Is it fine? This is something which we had already discussed. Okay. Exchange loss of 50 will continue to remain. Okay, so that takes care of this example. Chota sa example tha, just for our understanding. Okay. Done? Did you guys understand this? Yes. Okay, fine. The next one, the functional and presentation currency of P is USD, while the subsidiary is euros. P has sold goods having a value of 100 USD to S when the exchange rate was $1 equals 2 euros. At the year end, the amount is still due. Exchange rate is $1 equal to 2.2. How should the exchange difference be accounted for in the consolidated financial statements? So what entry parent will pass? Functional currency, dollar. Parent will pass the entry S limited debit to sales, $100. Okay. This is what is the entry that is going to be passed, and this will continue to remain at 100 even on the balance sheet date, because my functional currency is US dollars only. So what am I going to translate? I'm not going to translate anything. Okay. I am denominating my sale in my own functional currency. Coming to S, S will pass the entry purchases account debit to P. This will be 200 euros. This will be 200 euros. Acha, on the balance sheet date, I will convert it to the closing rate. So closing rate is 2.2. So there is a 0.2 exchange loss. So 0.2 into 100 gives you 20. So exchange loss debit to P, 20. Okay. So that is your exchange loss of 20. When you are going to consolidate, in note 1, when you are going to consolidate in note 1, what am I going to have? PS adjustment total. When I am going to consolidate debtors, there will be some figure. From here, I will adjust 100 and take the total. Okay. Whereas when I consolidate the creditors also, that time also I will be adjusting 100. Sir, why 100? Now it is at 220 euros, right? So divide by 2.2, that gives you 100 USD. So eliminate 100. Sir, what about 20 exchange loss? That will still remain. That will not go anywhere. Okay. It will be there in the P&L, and since this is the loss arising in the subsidiaries books, it will be divided between the parent as well as the NCI. It will be divided between the parent as well as the NCI. Is it okay? Yes. Have you understood? Obviously, because one is a functional currency, no? Parent is already having its own functional currency. So parent will not do a restatement. वो क्या restate करेगा? It's recorded in its functional currency. So subsidiary will do the restatement, and whatever gain or loss happens there, that is going to come in the consolidated financials also. Okay. All right. Sumit, समझ में आया? Ankur, did you follow? Rashmi, did you follow? Yes. Did everyone follow? Anybody has any doubts? All clear. Okay, fine. So coming to the next part, M Limited is engaged in the business of manufacturing water bottles for bottles for pharma companies and non-pharma companies. It is a wholly owned subsidiary of G Limited, which is engaged in the business of pharmaceuticals. G purchases the pharma bottles from its parent company. The demand of G is very high and the operations of M are very large, and hence to cater to its shortfall, G also purchases the bottles from the other companies. Purchases are made at competitive prices. M sold pharmaceuticals bottles to G for 12 lakh euros on 1st February 20x1. The cost of these bottles was 830 lakhs in the books of M at the time of sale. At the year end, that is 31st March, all these bottles were lying as closing stock with G. Functional currency of G is euro, while Indian rupee is the functional currency of M. Following additional information is available. Exchange rate on 1st of February, 1 euro equals 83 rupees, and on 31st March, 1 euro equals 85 rupees. Provide the accounting treatment for the above in the books of M and G. Show the impact on consolidated financial statements. Support your answer by journal entries. Okay, fine. So M Limited. M Limited's currency is INR. So we will record this transaction first. So I am selling it to G Limited. So G Limited debit to sales. So this is how many euros did I make the sale? Revenue recognized 12 lakhs into 83. 12 into 83. Correct? Bolo. 996. Okay, so this is the rupee value of sales which I have recorded. Now 83 becomes 85. So will I have to record an exchange gain? Obviously I have to, because my sale is denominated in euros. So there will be an exchange gain. So the entry will be G limited debit to exchange gain. This will be 996 into 85, sorry, 830 minus, not 996. 12 lakhs. What am I doing? 12 lakhs into 85 minus 83. So this is 24. Where will this exchange gain go? This goes to the P&L. This goes to the P&L. What entry G Limited will do? The functional currency is euros. Okay, so it is going to record the purchases. Purchases debit to M. So this will be euros 12. Euros 12 lakhs. So will I have to record any movement here? No, the invoice is denominated in euros. The invoice is denominated in euros, and because the invoice is denominated in euros, there is no exchange fluctuation that will happen as far as G Limited is concerned. By today I purchased 12 lakhs on 31st on 12 lakh euros. On 31st March I have to pay 12 lakh euros only. So there won't be any exchange fluctuations as far as G Limited also is concerned. Okay, so therefore no change on 31st March. No change on 31st of March. Okay, so now 12 lakhs was the value of your bottles. Okay, 12 lakhs was the value of your bottle. So that is the value at which your inventory also will be recorded. At which your inventory also will be recorded. Is it okay? Yes. Yes. So now M sold these pharma bottles to G. The cost of these bottles was 830 lakhs. जबकि आपने सेल किया 996 lakhs, and all these bottles were lying as closing stock with G Limited. So profit on stock is equal to 996 minus 830. So that gives you how much? That gives you 166. What is this 166? This is nothing but unrealized profit. And what are you going to do with unrealized profit? You will have to eliminate it. Is this an upstream or a downstream transaction? M is selling to G. So M is the parent, G is the subsidiary. So this is a downstream transaction. So nothing will be shared with the NCI. So the entry will be consolidated P&L account debit to inventory. Consolidated P&L account debit to inventory for the entire amount of 166. For the entire amount of 166. Okay, fair enough. So that takes care of this part. Yes, all clear? See, there's two small questions. Matlab, iske liye even if I have to make you write down, it will just take time, but it's not giving me any core answers. Okay, so that is why I have just taken it through you. I have taken you through it in a very brief manner because it's quite simple. It's quite simple. Okay, have you understood? Acha, what if M Limited made a sale to G Limited, denominated the invoice in dollars? There will be an exchange gain or loss difference for M Limited also and for G Limited also, because M is giving a dollar invoice. So it will get the payment in dollars. So there will be that difference. G Limited's currency is euros. but it is getting a dollar invoice. So that also restatement has to be done. So you will be having in both the cases a restatement, both the companies. Okay. Yes, all clear. So that is not restricted to one company only. It could happen in both the companies also. Is it okay? Yes, Rashmi, did you understand? Did you guys understand? Yes. Bolo. Everyone, please tell me, did you understand? Have you understood? Yes. Okay. All right. Fine. Now, coming to the next part and a slightly new concept for us. Okay. A slightly new concept for us. Okay. Rashmi, Soham, Ankur, आपने समझा बताया नहीं, is it clear or not? Soham, it won't be eliminated in G. It will be eliminated in the consolidated financials. Okay. It will be eliminated in the consolidated financials. Okay. 166 will be eliminated at the time of consolidation, not in the standalone. Okay. This will be eliminated at the time of consolidation, not in standalone. Standalone mein to it is over up till here. Okay. The elimination is in the CFS. All right, fine. Now there is a new concept known as NIFO. NIFO. Net investment. Yes, yes. Nahi baba, consolidated books are in INR. Read the question. M Limited is engaged in manufacturing bottles. Indian rupee is the functional currency of M. So M is the parent. Parent has made a subsidiary outside India. So अपना currency तो INR ही है ना. So therefore consolidated books will be in INR. Okay. वो थोड़ा लगता है इंडियन का सब्सिडियरी कैसे हो सकता है बाहर में यूरो और INR में. I understand. But यहाँ पे it is like that only. All right. Okay, fine. Now coming to NIFO. Net investment in foreign operation. Okay. See, parent and subsidiary have a very different relationship. Okay, sir, what do you mean by different relationship? It is a relationship of convenience. Okay. It is a relationship of convenience. What happens is many times you enter into such transactions with your subsidiary only for the fact that you have to do something. So you enter into a transaction. Okay. Like for example, subsidiary wants urgent funds. Subsidiary wants urgent funds. So what the parent does, parent says, I give you a loan. इसको बोलते हैं it is a relationship of convenience. Subsidiary को चाहिए था, parent wanted, gave the loan. Okay. Let us now think further. I am now only setting up operations in my subsidiary's location. Okay, fresh hai. So because it is a fresh location, what I am doing is I have already taken, okay, let me take some numbers. Okay. I have the parent in India, subsidiary in UAE. Okay. So initially invested amount, invested 100 rupees 10 crores into UAE. Initially, I have invested 10 crores into UAE. For 10 crores, I took the permissions of the companies, of the government in UAE. I have formed a company. I paid the necessary taxes. I got the incorporation certificate. I got my lease agreements. I got my manufacturing permissions. Everything I got out of this 10 crores. And I started to operate in UAE. Now, UAE, initially every entity will be a loss-making entity. Okay. So UAE was a loss-making entity initially. So obviously, since it is a loss-making entity, it is burning cash. It is losing cash because orders abhi tak aaye nahi hai. They don't have the orders on hand and they are just new in the market. So it is a loss-making entity. Since it is burning cash, it will need cash from somewhere. If UAE entity approaches banks in UAE, they will tell, sir, look at your balance sheet. Your balance sheet is not strong. You are continuously making losses. We cannot do any financing. तो फिर वो कहां जाएगा? वो जाएगा अपने इंडियन माँ बाप के पास, पेरेंट के पास, बोलेगा look, I don't have money to pay my creditors, I don't have money to pay my employees, I don't have money for anything because the operations is taking out my cash. Operations are sucking away my cash. So I am in a very dire straits. Meri madad karo. Please help me. So then the Indian parent is what it will do. The Indian parent will tell, look, I will give you a loan of another 5 crores. I will give you a loan of 5 crores. UAE entity will tell, Arey, I don't want a loan because I cannot repay this loan. I cannot repay this loan. You give me an equity contribution of 5 crores. The UAE subsidiary is telling the parent, mere ko loan nahi chahiye, give me equity of 5 crores. So the Indian parent is telling, look, if I give you equity, I again have to go through all the permissions. I will have to go to the registrar of companies in the UAE. I will have to do the formalities, hire a company secretary, increase the authorized capital, then pay the taxes. Then there is a whole lot of administrative hassle which is there. So I am giving you 5 crores. You take, it is only in paper. That means in form. It is a loan. इसका कोई repayment period नहीं है. There is no repayment period. There is no repayment terms and conditions. No interest also. Nothing is there. I'm just giving you these 5 crores to meet the cash requirements that you're having. You do not have any obligation to pay it. We will continuously roll over this loan on an annual basis. We will roll over this loan on an annual basis. Chalo, even if I put an interest, I will only tell you pay the interest. Nothing is required as far as the principal is concerned. Nothing is required as far as the principal is concerned. I'll not give you any obligation. This 5 crores, I'm structuring it as a loan only to avoid the hassles that I will have to do for making it an equity contribution. So UAE subsidiary will say, tab to theek hai. What I want is money. How you structure the transaction is your lookout. You can give it as a loan, you can give it as equity, whatever it suits you, you do that. But I will not be in a position to pay the 5 crores, at least in the foreseeable future. Indian parentals, wo mere ko malum hai. You don't worry. I'll give you the 5 crores to tide your bad times. Okay. So UAE agreed and gave this money. Now, in the Indian subsidiaries books, in the Indian parents books, on the asset side, loan to S will appear at 5 crores. Loan to S will appear at 5 crores. My question to you is this a monetary item? Is this a monetary item? Yes, It is a monetary item. If it is a monetary item, will there be a restatement that needs to be done? Will there be a restatement that needs to be done? Yes, there will be a restatement that needs to be done. So who will do the restatement? India has given the loan in rupees. So UAE will do the restatement. UAE will do the restatement. Where will this restatement go? This restatement will go to the profit and loss account in the standalone books. Okay. So restatement, standalone, where will it go? It will go to the P&L. It will go to the P&L. Okay. In the consolidated, in the standalone books. Now, when I talk about consolidation, tell me, in substance, now please pay attention. In substance, is this actually a loan, or is this not in the nature of loan, but in the nature of investment? Is this not in the nature of loan, but in the nature of investment? What do you think? इतना सब कहानी बता दिया मैंने. So tell me, for consolidation purposes, is this in the nature of loan, or is this in the nature of an investment? It is in the nature of investment. ना कोई repayment term है, interest also is flexible, payment का कोई deadline नहीं है, nothing is there. So it is practically in the nature of investment. Only thing is it is structured as a loan. Only thing is it is structured as a loan. So what am I going to do? In the consolidated financials, whatever restatement gain or loss is there, I will reclassify to FCTR. I will reclassify it to foreign currency translation reserve. Yes, I will reclassify to foreign currency translation reserve. Kahan pe hoga ye? This will be in the consolidated financials. See, standalone financials, UAE will record the receipt in dirhams, prepare its financial accounts in dirhams. So there won't be any question of FCTR there. Okay. Whatever restatement I am going to do, I will take it through the profit and loss account only. Okay. I will not do anything through the FCTR. I will not do anything through FCTR. Okay. So this is what you are going to do. In the consolidated financials, you will do a reclassification entry from the consolidated from the P&L to your FCTR. That's it. So these type of transactions are known as net investment in foreign operation. See, in Ind AS 109, what happens is, it is quite same as 109, but why we are dealing it separately is, we will be having a documentation. A lot of things go in a gray area. Okay. We will be having a documentation calling it as a loan agreement, telling that there will be a repayment. They will word the terms repayment at convenience of the borrower. Okay. They will somehow try to ensure that this will be taken as a liability. Okay. This will be taken as a liability, because if this agreement is shared with the UAE authorities, the UAE authorities should not come to the conclusion that this is an investment which is being made. Ultimately, they have to structure the contract in such a way that the UAE authorities have to be convinced that 5 crores is a loan and it is not an investment. So for that purposes, the contract will specify, and financial instruments chapter, what the very first thing, financial asset or financial liability, when you look at the definition, it starts with the term financial liability is a contract, or financial asset is a contract. So there is a contract. So the base for recognizing it as an asset or a liability, as a equity or a liability, will arise on the basis of that contract. So the contract will be worded in such a way that it appears to be a loan. But when we move behind the substance and when we consolidate it in the India's books, in the Indian parents' books, that point of time, I cannot say that this is a loan transaction. I will say that this is a net investment in foreign operation. The movement, I will take it to FCTR. The movement, I will take it to FCTR. But will I still record it as an asset? Yes, you will record it as an asset. You will record it as a loan that is given. You will record it as a loan that is given. Okay. So now coming back to our exam, coming back to the discussion, we could be having certain cases where transactions like debtors, loans, etc. You have given the form of a short-term receivable or payable, but in reality, it appears to be that of an investment. तो इसको हम लोग बोलते हैं net investment in foreign operation. And whatever gains or losses are arising on account of translation of balances which form a part of my NIFO, that is net investment in foreign operation, that balances or translation differences will be taken not to the P&L but will be taken to the FCTR, since the settlement does not happen on a priority. The settlement does not happen in the near future. Okay, so when we talk about, now coming back, you can take note of this. Foreign currency gain or loss on intercompany monetary items. Monetary items. For example, loans, debtors, creditors, advances. Okay. So when you have these items, there are two chances. One is genuinely debtor, creditor, loan. That is, settlement is planned. Settlement hoga, definitely hoga. Okay. Example, debtors, creditors, short-term loans. Okay. So now when this is the case, standalone financial statements, where are you going to record it? Sir, I will record it in the P&L. Consolidated financial statements, where will you record? Sir, here also it will go in the P&L. Absolutely right. No reclassification. No reclassification. Okay. Whereas in this case, settlement is not planned. Settlement is not planned. Example, loan with no repayment terms. No repayment terms. Okay. So standalone financial statements, where am I going to take? P&L. Whereas consolidated financial statements, where will I record it? Reclassify to FCTR. Reclassify to FCTR. Whatever be the Forex gain or loss, I cannot keep it in the I cannot keep it in the P&L because it's not going to be realized, and that is why I will be recording it in the FCTR. I will be recording it in the FCTR. Is it okay? Yes. All clear? So that is all about net investment in foreign operations. Okay, net investment in foreign operations. All right, fine. So now coming back to our notes, now you will understand what is the meaning of NIFO. I had told you not to look at the NIFO part right now. Now I'm telling you, you will have to look at that. Okay. So net investment in foreign operations. This is the amount of reporting entities' interest in net assets of that operations, which will include your equity investment also, and all these transactions which are structured as debtors or which are structured as a loan arrangement, say with no repayment terms. So that also will form a part of my net investment in foreign operations. So net investment in foreign operation versus intra-group balance, how do I differentiate? An item for which settlement is neither planned nor likely to occur, it may form part of my NIFO. So for example, short-term loan getting rolled over continuously, regardless of subsidiary's ability to repay, has the same effect as that of a capital contribution, long-term receivables or loans. So we call it as NIFO. Item for which settlement is either planned or likely to occur in the foreseeable future. Matlab hoga. So this is an intra-group balance. Example, trade payables or trade receivables. The problem is, from an audit perspective, how do I ensure that this is classified correctly? It's a very difficult task. Okay, so that will be based on the existence of auditable evidence documented by the management. Okay, I can only rely on the documented evidence. It's a very difficult area for us to audit. Okay, so even we had a certain issue we had studied lease contracts, if you remember, and in the lease contracts we have to evaluate whether the transaction contains a lease or not. The contract was so worded that we could not even dispute the terms of the contract by saying it contains the lease. It was structured in such a way that I am operating as an entity in one of my customer's premises. I am operating as an entity in my customer's premises, and in the customer's premises I have my own plant, machinery, expansion, everything is going on. The lease contract, see, I am ultimately operating in the premises of the customer. So the customer has entered into a lease contract for a period of 12 months only. And this 12 months gets rolled over time and again. But there is no rolling over which is mentioned in the contract. The contract mentions that the termination can happen at a short notice. The contract mentions that there is no escalation that is permitted. All these things worded in the lease contract gave the confidence that it cannot be a lease arrangement as contemplated under Ind AS 116. At the same time, the fact that I am manufacturing exclusively for the customer, the fact that I am having my plant and machinery given to them, that means unko jo bhi product chahiye, I am going to manufacture. Third one, the fact that I have made a substantial expansion to this plant which is within the customer's premises. All these things give an indication that I am there for a long-term future, not for only 12 months. But because the contract is so beautifully worded, we could not take it as a lease contract. We had to take it as a operating lease arrangement. These companies do this kind of agreements to ensure that they don't get a debt burden in their balance sheet. They don't get a debt burden in their balance sheet. So it becomes very difficult for the auditors also to point and say that this is a lease contract, this is a net investment in foreign operation. So there you have gray areas. There you have gray areas. So like they say, financial statements are prepared using judgment. Similarly, for audit, it's ultimately the existence of auditable evidence that will help you to decide whether it will be a net investment in foreign operation or whether it will be an intra-group balance. Okay, so anyways, that was just a discussion. So we have done this part also. Okay. Now, exchange differences arising on a monetary item that forms part of NIFO. Initial recognition will be in other comprehensive income when you are consolidating under the equity method. On disposal of a foreign operation, whatever is there in the FCTR recognized in OCI and accumulated in separate component of equity. Separate component of equity का मतलब ये सारे jargon का मतलब है accumulated in FCTR shall be reclassified from equity to P&L. Shall be reclassified from equity to P&L. Gray areas means, Viraj, there is no certainty about what you are going to record it as. For example, I have a contract where there is a loan that is given and the repayment terms are not specified, but there is an interest period. There is a clause saying that repayment has to be done. All these things are there. At the same time, when the repayment will be done, what are the installments? All of that is not given. So when this is the case, the document makes your treatment a gray area. It is not, you cannot say it is an investment in foreign operation. You cannot say it is intra-group balance also. You are somewhere in between. That point of time, we call that as a gray area. हम इधर भी कूद सकते हैं, उधर भी कूद सकते हैं. So that point of time, ultimately what the management believes it to be is what will help us as auditors. Okay, उसको हम लोग बोलते हैं gray areas. Nothing is right, nothing is clear. You can only have documentation to rely on. Okay, so foreign operations is done, exchange difference is done. Okay, so go through these questions for homework. These are short theory questions. Okay, try to do these questions for homework. We have done translation of foreign operations. We have done this part. Okay. Exchange differences forming part of NIFO. I told you, recognize in OCI, accumulate in a separate component of equity. Yani we call this as FCTR. I told you. Exchange difference on monetary items not forming part of NIFO, take it in the P&L. I have told this also. Okay. We have seen these questions already. Okay. So, we have done these questions. Okay. All right. Now coming to our discussion on consolidation. See, in consolidation, we have two things which happen. Yes, it is an unclear or unclear transaction. बोल सकते हो. You can say that. Okay. Yes, you can say that. It's not certain what you want to treat it as. Okay. All right. So now coming to business combination, we had two things which were there. One is fair valuation of identifiable assets and liabilities taken over. And second is the goodwill that arises on the consolidation. So goodwill arising on acquisition and any fair value adjustments shall be treated as assets and liabilities of that foreign operation. Correct. Because it is related to the foreign operation, it will be treated as assets and liabilities of the foreign operation. Since they are expressed in the foreign currency, you will have to convert it to the functional currency. Translated at the exchange rate, as is the case for other assets and liabilities. Which exchange rate? closing exchange rate. All assets, liabilities you translate at closing rate. Similarly, even the goodwill on consolidation, you will translate at the closing exchange rate. Okay, so that is everything you have to know about consolidation also. Okay, so what we will do is we will be doing a question on consolidation after the break. It's 8:45. I will quickly run you through this question. Okay, and then we'll see the problem. The solution is there. Most of it is what you already know. So I want us to understand the way the things proceed, and then we'll just look at disposal and we are done with the chapter for today. Okay, so let us take a 5-minute break. It's 8:45 now. We will resume at 8:50. 8:50. Okay, we take a 5-minute break. Okay, all right, fine. Yes. Okay. So are we live? Hello. Hello. Okay. Yeah. All right. So we are live. So now let us quickly pick up a question on consolidation in foreign subsidiary. Okay. I'll take you through the steps and we will see how the things proceed. Okay. So Bharat Communications acquired 80% of Ceylon Telecom PLC for 10,40,000 rupees on 1st January 20x5 when the retained reserves of Ceylon Telecom were Sri Lankan rupee 50 lakhs. The financial statements of Bharat and Ceylon for the year ended 31st December are as follows. Statement of financial position, you are given in rupees for Bharat Communications and in Sri Lankan rupee for Ceylon Telecommunications. So property, plant and equipment, investment in Ceylon, current assets, share capital, retained earnings. Statements of financial position as at 31st December continued. You have loans and current liabilities. Statements of profit or loss and other comprehensive income for the year ending 31st December. You have revenue, cost of sales, other expenses, dividend, profit before tax, income tax expense, total profit, total comprehensive income. For the year ended 31st December X5, the total comprehensive income was 24 lakh Sri Lankan rupees. On 31st December X5, Ceylon Telecom paid dividends of 6,90,000 Sri Lankan rupee. An impairment test conducted at 31st December revealed impairment losses of 2,96,000 relating to Ceylon PLC's goodwill. No impairment loss was previously recognized. It is the group policies to translate the impairment losses at the closing rate. At the date of acquisition, Bharat Communications chose to measure the non-controlling interest at proportionate share of fair value of net assets. Statement of changes in equity, you are having opening balance, dividends paid, total comprehensive income giving the closing balance. You are having opening rate 1st January 20x5, 31st December x5 rate is given, 31st December x6 rate, that is the closing rates are given, average for x5 and x6 is given. Prepare the consolidated balance sheet, P&L and OCI. So we will ignore the P&L and OCI of the Bharat Group for the year ending 31st December 20x6. Okay. It won't take much time. I have the solution drafted for our understanding. Okay. So this is the problem that is there for you. Okay. This is the question. It's Bharat, not Mananam. Okay. That's it. Okay. All right. And Ceylon. Okay. Questions are the same. All right. Fine. So let us start. See, I have given it in two presentations. Okay, I have given it in two presentations. We will do it the way we are normally going to do it. Okay, that is the 5-step model that we have followed. We will be doing it in that way. Okay, so let us start. You can look at the alternate presentation out of your own interest. Okay, but I will be doing it using the using the method that we follow. Okay, so now coming back, see, I am given the balance sheet of Ceylon Telecom. So what does Ind AS 21 tell us? First thing, all assets and liabilities will be translated using the closing rates. Okay. So now if you look at restated balance sheets of Ceylon Telecom PLC, you have share capital, property, plant, equipment, current assets. Okay. So we start. So 31st December X6. What is the exchange rate which is given? See, 31st December X6 exchange rate is 8.1. So now plant equipment I am translating using 8.1. Current assets I am translating using 8.1. Loans, current liabilities I am translating using 8.1. Okay, so this is what is my assets and liabilities converted at the closing rate. So that is converted to these amounts. Now we move on to the profits, equity share capital and reserves. Okay. So now when did I acquire? Well, I have acquired on 1st January 20x5. Since I have acquired on 1st January 20x5, the share capital will be converted at the rate on the date of acquisition. The rate on the date of acquisition is 9.4. So I am converting the share capital at 9.4. Same goes for pre-acquisition retained earnings. Same goes for pre-acquisition retained earnings because you are buying these reserves. You are purchasing these reserves. 20x5 was the year when you had the control. 20x5 was the year when you had the control, and that is why the profits earned in 20x5 is how much? Profits earned in 20x5, have they given to us? Yes. In the year ended 31st December X5, Ceylon Telecom's total comprehensive income was 24 lakhs. When was this profit earned? 20x5. Did I have control? Yes. So you will translate using which rate, sir? I will translate using the average rate of 31st December 20x5. Sorry, average. That is 9.1. Average rate 9.1. So I have translated using the average rate of 9.1. Dividend is a payment that is made. Dividend is a payment that is made. Payment happens on a specific date, and that is why we take the rate on the date of payment. 31st December X5, it was 8.8. So I am converting using 8.8. This is a payment. Bank se paisa gaya hai, so that day the rate is 8.8. Year 20x6, did I again make a profit? Yes. What is the profit that we have made? What is the profit that we have made? Total comprehensive income is 27 lakhs. Okay. So we convert using the average rate of 8.4. We convert using the average rate of 8.4. Again, dividend is paid on 31st December X6. Dividend is paid on 31st December X6 of 8,10,000. So we convert using the rate on the date of payment. Okay, so once this is done, I have converted all the items of my reserves using the appropriate rates. And then when I go to balance the rupee column of my balance sheet, I get an FCTR balance of 1,57,205. I get a balance of 157,205. Are you convinced about the conversion part? Yes. Are you convinced about the conversion, everyone? We've still not yet started consolidation. Abhi to we have just converted the balance sheet of the subsidiary. Right now we have just converted the balance sheet of the subsidiary. Are you convinced? Yes. All right. Great. So everybody is okay with the conversions. We got a balance in the FCTR. Now let us move on to the usual steps. One is note, you draw the balance sheet format. Okay. You draw the balance sheet format. Assets and liabilities, that is Bharat, Ceylon, adjustment and total. Record the balances as it is. So this is from the balance sheet of Bharat, and Ceylon ke case mein this is from the balance sheet restated total. Then equity share capital will be of the parent, so no doubt here. And then other equity, you are having whatever is the amount. We will see how we get that. Okay. Next, working note 3, consolidated reserves. We are having two reserves. One is retained earnings and the other is FCTR. So standalone of Bharat Communications, how much is that? From where did we get that? Bharat Communications retained earnings standalone 22,30,000. Okay, so we have recorded that. Then we will have share in post acquisition reserves of Ceylon. We will see how that comes up. Okay, all right, fine. So now coming to our cost of control account. I have made an investment in Ceylon Telecom. How much? 10,40,000 rupees. Sir, कहां से दिखा आपको? Sir, वो यहां से दिखा. 10,40,000 rupees. Okay. 10,40,000. This was made on which date? Sir, this was made on 1st January 20x5. What was the rate on that day? 9.4. So 10,40,000 to 9.4, I will get 97,76,000. This is the equivalent amount on the date of acquisition of my investment in Ceylon Telecom. Okay. Equity share capital, 80% I have acquired. So that is 20 lakhs. Do we see 20 lakhs? Yes. 20 lakhs into 80%. So that is the usual what we do. So you get 16 lakhs. Pre-acquisition retained earnings. Pre-acquisition retained earnings is directly given to you. तो वो कहां पर है? Where is that 50 lakhs? 1 second. Communications, retained earnings, statement of profit or loss, balance as at, okay, as at 31st December, 86 lakhs का ब्रेकअप किधर दिया है क्या? Retained earnings 50 lakhs. 1 second, just a minute. Balance as at 1st January. We have acquired it for 10 lakh. Achha, here only it is given when the retained earnings were Sri Lankan rupees 50 lakhs. Yeah. So 50 lakhs ka 80% is recorded here. Okay. So I ultimately get my goodwill at 41,76,000. I ultimately get my goodwill at 41,76,000. Fine. Is this the normal way you calculate the goodwill? Yes, sir. This is the normal way you calculate goodwill. Okay. Investment in Ceylon, investment in subsidiary, equity share capital, pre-acquisition reserves. So this is the goodwill. This is the value on 1st January 20x5. याद रखो, this value does not change. 41,76,000 remains at 41,76,000. It can change only under two circumstances. One is measurement period concept under Ind AS 103. वो अभी applicable नहीं है because we are completed more than 1 year of investment. The second one is impairment. So impairment we will have to go ahead and look at the data which is given in the question. As of now 20x5 कोई impairment नहीं है, 41,76,000 we record, but we will have to translate it. Now these are the assets of the subsidiary. So when I have to convert, I will use the closing rate. I am in the year 20x5. So the closing rate for 20x5 is how much? Sir, it is 8.8. So there you go. I translate at 8.8. I get 4,74,545. This gives me a balancing figure in the INR column, which is going to go to FCTR, This is only on account of different exchange rate. Dekho 9.4, 9.4, 9.4, and here it is 8.8. So the difference that arises is on account of different rates. So it goes to FCTR, and this will be attributable to the parent only. Since it is partial goodwill. Otherwise, your FCTR is a reserve. Reserve has to be analyzed. So reserve will be attributable to parent as well as NCI. But since this is partial goodwill means goodwill is attributable only to NCI. That is why the FCTR arising on the goodwill translation will also be attributable only to the parent and not to the NCI. All right. Coming to 20x6, I bring forward the goodwill. Dekho, 41,76,000 it was there earlier also. Now also it is brought down at 41,76,000, 8.8. All right. And then I am in the year ending 31st December x6. So therefore I will translate using closing rate of 8.1. So when I do 8.1, I am getting 5,15,556, which again gives rise to an FCTR of 41,010. 41,010. This is the FCTR again that is attributed to the parent only, as it is partial goodwill. All right, fine. Next one, somewhere they have given an impairment test conducted at 31st December revealed impairment losses of Sri Lankan 2,96,000 rupees. Sri Lankan rupee 2,96,000 is the goodwill impairment loss. So fine. So 2,96,000, 8.1. 36,543. So now the goodwill balance is 38,80,000. This is changing due to impairment. Is it permitted to change due to impairment? Yes. So we have changed it due to impairment. So this is the goodwill that will appear in the balance sheet as at 31st December 20x6. Have you understood everything about goodwill in detail? मेरे को बताओ. Have you understood everything about goodwill in detail? Yes. Can I proceed further? It is exactly the same way what we used to calculate. All right. So no difference. Coming next, NCI, bacha hua 20% of 20 lakhs, 20% of 50 lakhs. So we will translate using the closing rates, using the rate on the date of acquisition 9.4, 9.4 to balance carried down 148, 936. Okay. And by balance brought down 148, 936. Right now we'll keep it here. Then we will see what to do about the remaining. Okay. Next. Now we just have to analyze the retained earnings. Okay. How do I get my retained earnings? I have already done that working. Retained earnings in Sri Lankan rupees. We already have that figure. How much is it coming to and where is it coming from? Retained earnings in rupees on 31st December 20x6. Okay. So retained earnings in rupees. 1 second. minus 78,409. It is the total of these items. Total of these items. Okay. So this comes to 938. Just I'm writing below due to lack of space. 671. That is what I am analyzing here. That is what I am analyzing here. 938,671. And this 9,38,671 is divided as 5,31,915 pre-acquisition and balance is post-acquisition. Okay. Sir, dividend payment हो रहा है. Yes, dividend payment is happening on 31st December X5, 31st December X6. Because the dividend payment is happening post-acquisition, do I have sufficient post-acquisition profits? Yes, I have sufficient post-acquisition profits. I earned profit of 2,63,000, dividend of 78,000. 3,21,000, dividend of 1 lakh. So in absence of information, I can assume that this dividend is out of post-acquisition profits, and therefore there is no need to pass the adjustment entry of taking it to cost of control account. Okay. So this amount is my post-acquisition. So we just proceed to that. Pre-acquisition is this figure which is taken to working note 3 and working note 5 respectively. Post-acquisition 3,25,000 and 81,351. Okay. So that takes care of pre-acquisition retained earnings also. Okay. And finally, my FCTR. Okay, so FCTR as per the balance sheet is 1,57,205. This is the balance sheet that we have converted. This is the balance sheet that we have converted. Okay, now the balance sheet that we have converted has this FCTR. Is it going to be pre or post? Sir, it will obviously be post. It will always be post. FCTR will always be post acquisition. Why, sir? Why always post? Arey, when will you do the translation? You will do the translation only when you have the control. And because you are having control already when this reserve came into existence, it will always become a post-acquisition reserve. Your FCTR arises after you got the control. Before you got the control, you cannot go and say, I will take, for example, I will translate Apple Limited's reserves and take it into my balance sheet as a, where is the control? The moment you have the control, only then you can have your FCTR. So 80% goes to the parent, 20% goes to the NCI. This is your share in FCTR post acquisition. Okay. FCTR due to restatement of partial goodwill, I had restated it twice. 20x5 30,290 plus 41,010 in 20x6. You can have a look here. 41,010 plus 30,290. This is attributable entirely to the parent. Why? Because it is partial goodwill. So 71,300 is your post. So what is your FCTR going to look like? 1,97,065 goes to the parent in working note number 1, directly in NCI in working note number 5, that is 31,445. Okay. So in your NCI, you will be having post retained earnings, post FCTR. That gives you 2,61,728. 1,97,000 I am taking straight to note number working note 3, 197,065. Impairment of goodwill we have already taken somewhere, it is there. 36,543. This goes entirely to the parent because it is partial goodwill, and post Ceylon is the reserves 3,25,000. kahan gaya? 325,405. So that is what comes here, 25,18,000. Just take the totals and post the balances. You should be getting a tallied balance sheet on account of consolidation. So that is how you will do the consolidation process. That is how you will do the consolidation process. So what all things are you going to take care of when you are doing the consolidation? What all things are you going to take care of? First one is all the items will be converted using the closing rate, assets and liabilities. You will calculate the goodwill on consolidation in the COC account in the foreign currency and then translate it at the closing rate. This will give a balancing figure in the functional currency, which will be taken to the FCTR, Unrealized profits in case of intercompany, you will have to eliminate. Yes, you will have to eliminate. Pre-acquisition dividend needs to be eliminated while preparing the consolidated P&L. Parent would be recording at the rate on which the dividend was paid. Intercompany debtors, creditors are monetary items. You will convert using the closing rates and eliminate them. Okay. So in the consolidation process, the change is what? First, you will restate the foreign subsidiaries trial balance into that of the functional currency. And then the FCTR is a reserve. That is, you will have to analyze it between the parent and the NCI. It will always be a post-acquisition reserve because it arises only when control exists. All right. And cost of control account will be prepared in columnar form. One for the currency of the subsidiary and the other is the functional currency. So these are the changes which you will do in the consolidation process for the purposes of Ind AS 21 with Ind AS 110, consolidation of financial statements. Is it okay? Yes. Any doubts so far? Any doubts? Nothing new. Only thing what is new is the fact that this has been taken as a, what you can say, foreign currency subsidiary. That's it. Otherwise, it's a very plain, simple question on consolidation. All clear? Rashmi, Soham, Ankur, आपको समझ में आ गया? I know I hurried it, but see, if we sit to solve, there is a lot of only arithmetical calculation. कहीं पे conceptually there is nothing new which I have discussed right now, apart from the exchange rates. Okay. So that is why I thought let us continue it this way, because if we sit to solve this one question only will take nearly 1 hour, and what we will be doing is only division and multiplication. That's it. Okay. So that takes care of the foreign currency subsidiary consolidation. Okay. Go through this question for homework. Theory question hai, pad lena. Okay. All right. Fine. Next. Okay. Global Limited, an Indian company. Okay. All clear. Fine. So there is this company, Global Limited, an Indian company acquired on 30th September 20X1, 70% of the share capital of Mark Limited, an entity registered in Germany. The functional currency of Global Limited is rupees and the financial year ending is 31st March 20X2. The fair value of net assets was 23 million euros. Purchase consideration paid is 17.5 million euros on 30th September X1. What is the value at which goodwill has to be recognized in the financial statements of Global Limited as on 31st March 20X2? Second, Mark Limited sold goods costing 2.4 million to Global Limited for 4.2 million euros during the year ending 31st March 20X2. The exchange rate on the date of purchase by Global Limited was 83 rupees per euro, and on 31st March was 84 rupees per euro. Entire goods purchased are unsold. You will have to determine the unrealized profit to be eliminated in the preparation of consolidated financial statements. Okay. So you guys want to try, you can try this out. I'll be waiting for a couple of minutes. Just try this out. I think you should be able to get this answer correctly. Okay. Try this out fast. Tell me what is the answer. Yes. Try it. Yes. Okay. So let us just quickly go through. Global Limited acquired on 30th September. Fair value of net assets was 23 million. So net assets account debit 23 million. This is obviously euros. To bank, this is your purchase consideration paid. What is the purchase consideration paid? Sir, it is 17.5 million. All right. And then you will be having to NCI. So NCI, there is no fair value given. So we will have to take it at proportionate net asset. So 23 into 30%. So that is 6.9 million. So 6.9 plus 17.5 minus 23. So that gives you a goodwill of 1.4 million. This is the goodwill on the date of acquisition. On the date of consolidation, 1.4 million into what is the exchange rate on 31st March was 84. So into 84. So that gives you how much? 1.4 into 84 into 84. So that gives you 117.6 million. 117.6 million. Have you understood? Yes. So hum check your answer. $11 crore 76 lakhs. 11.76 crores. Yes. Did you understand? Have you understood? Bolo yaar. Okay, fine. So that takes care of the first part. Coming to the next one. Selling price of inventory is 4.2. Cost of inventory is 2.4. So unrealized profit is 1.8 million. This inventory is entirely in stock. Exchange rate on the date of purchase is 83. So 1.8 into 83. So 1.8 into 83. 149.4 million rupees. 14 crore 94 lakhs. You will have to eliminate. eliminate in the consolidated financial statements. Eliminate 149.4 in consolidated financial statements. Okay, so that takes care of this easy question on goodwill and inter-profit eliminations. Okay, so that completes our discussions on Ind AS 21 consolidation perspectives. Okay, Ind AS 21 consolidated perspectives. All right, and now we come to the questions on disposal of net investment in subsidiary. Very simple. Up till now, whatever balances were there in FCTR, we will ultimately transfer it to profit and loss as a reclassifiable through OCI reserve. Okay, so we just note that particular thing down. Disposal of net investment in subsidiary. Basically, the impacts, this is only the impact on FCTR which we are going to discuss. Okay. When the disposal leads to a loss of control, what are you going to do? Well, FCTR appearing in consolidated financial statements, that is parent's share of FCTR transferred to P&L account. Why? Because now you have realized it. FCTR represents that profit which is not realized. Now you sold it. So what are you going to do? You will transfer it to P&L. Transfer to P&L. Whereas in case there is no loss of control, part of FCTR, you will just allocate it to NCI. Okay. You will allocate to NCI. That's it. Done? Acha, sir, I lost the control, but I retain some small percentage. I lose the control, but I retain some small percentage. That point of time, do I do proportionate reclassification? Answer is no. Ek bar control gaya. Once the control is gone, how can you have FCTR in your books? You are having FCTR implies that you are investing in an entity over which you have control or significant influence, right? So therefore, here I don't have the control. I only hold a small percentage. So therefore, I have to eliminate the entire FCTR by reclassifying it to the profit and loss. Okay. All right. Let us look at one question on this. Where is that question? Just a minute, please. Let me see that question where it is. Fair value adjustment. Okay. Example 3. Sells 70%. 1,500. Okay. Just a minute. I'll just check if any question is there to be done. Okay. We have some examples and one question is there. Okay, fine. Let us do this. So this is from your study module. So parent P owns 100% of the foreign subsidiary S. P sells 70% of its investment and loses the control. Of course, I'll be uploading the answer sheet also. Okay. Parent P, I'll be uploading it in the assignment section by end of today. Okay. I'll be uploading it by end of today. So you can have access to it. Parent P owns 100% of foreign subsidiary S. P sells 70% of investment and loses control. So what will I do? FCTR balance transferred entirely to P&L. It is basically asking what is the accounting treatment. So as far as consolidation is done, you will remove the net assets, remove the NCI, remove the goodwill, all that you are going to do. Additionally, any FCTR balance which is there, you will transfer entirely to the P&L. So very simple. It's just to make you aware of what you already know. Parent P owns 100%. P sells 10% of its investment and retains control. So no loss of control. 10% FCTR reclassified to NCI. 10% FCTR reclassified to NCI. Last one. Parent P owns 35% of foreign associate B. P sells a 5% stake and retains significant influence. So you are aware of the accounting. Okay. So therefore 1/7, 5 by 35, that is 1/7 share in FCTR transferred to P&L. I'll not reclass to NCI here because मैं खुद ही NCI हूँ. I am only the NCI in this company. Okay. So therefore I will reclass it to P&L. I will reclassify the FCTR to P&L. Okay. So that takes care of the concepts. Coming to the last question. Question number 1, page 10.102 of your study mat. Okay. Parent P acquires a 90% subsidiary of subsidiary S couple of years ago. Now sells the entire investment for 1,500 lakhs. Net assets are 1,000. NCI in S is 100 lakhs. Cumulative exchange differences are gains of 200 lakhs. This is FCTR, resulting in P's foreign currency translation reserve in respect of S having a credit balance of 180 lakhs, while the cumulative exchange attributed to NCI is 20 lakhs. Calculate P's gain on disposal. Okay, I'll come to that, Viraj. Let me complete this. Okay, calculate P's gain on disposal in its consolidated financial statements. Very simple. एक तो मैं sale कर रहा हूं, so entry will be bank account debit 1,500. Second, NCI is vanishing, so NCI debit 100. What else is going? Net assets are going to go from my consolidated balance sheet. So net assets 1,000. Next, what else are you going to lose? To goodwill. Do I have the data? I don't have the data. I leave it as it is. To gain on sale. 600. To gain on sale 600. This is the first entry. Second entry, what you will pass is FCTR OCI debit to P&L. How much will I transfer? I give you 3 options, 180, 20 or 200. Kitna transfer karunga main? How much should I transfer? 180 parent share, 20 NCI share, 200 entire share. How much do I transfer to P&L? 180, 20, 200. One student is saying 180. What about the others? Rashmi, Shailendra, Saksham, if you're watching, Ankur gave the answer. Sanjay Pal. Yes. Any answers? Today the interaction has been fairly less. Either you guys didn't understand anything or I did not understand you. Okay. All of you have given the right answer. It should be 180. Those of you who are thinking it should be 200, it cannot be 200 because 20 is included in NCI and NCI is already eliminated. 20 is included in NCI and NCI is already eliminated. So only the parent's share in FCTR is what is going to be eliminated. Only the parent share in NCI is what is going to be eliminated. Okay. So that concludes our discussion on elimination also. That concludes our discussion on elimination also. Okay. All right. Couple of theory points. Change in functional currency is permitted, not so simple. See, when you are functional currency is what? It is the currency of that economic environment which influences your sales, costs, etc. So that currency cannot change so easily unless it is a change in the underlying transactions, events and conditions. Okay, not changed unless there is a change in the relevant underlying transactions, events and conditions. Okay, all right. You need to revise what, Soham? Events and conditions. If circumstances change and a change in functional currency is appropriate, then the change is obviously going to be accounted for prospectively. Okay, the change will be accounted for prospectively. So all items are translated into the new functional currency using exchange rate at the date of change. The resulting translated amounts for non-monetary items are treated as their historical cost. Exchange differences from the translation of a foreign operation previously recognized in other comprehensive income, they will not be reclassified to profit or loss until the disposal of the operations. Okay, all right. Exchange gains or losses accumulated in equity FCTR not transferred to P&L immediately. Okay, all right. So that's about it. One second. All right, fine. Since entities prefer to present financial statements in their functional currency, a change in functional currency may be accompanied by a change in presentation currency. Presentation currency is an accounting policy, so you should apply it retrospectively in accordance with Ind AS 8 unless impracticable. This means the change should be treated as if the new presentation currency had always been the entity's presentation currency, with comparatives also being restated into the new presentation currency. Okay, so these are the disclosures: exchange differences, presentation currency being different, change in functional currency displays. Okay, so that is what you are going to do the disclosure. Anything major? Disposal of foreign operations we have discussed. The accounting, this is done. Translate to NCI. Disposal is done. Yes. Okay. So I think most of it is covered. Nothing else is done. Coming back to treatment of advance paid or received. This is Appendix B to Ind AS 21. What we will do is we will look at one of the questions and then we will try to come back to the theory and understand it. So that way a question ka question bhi ho gaya and theory ka theory bhi jaldi se ho jayega. Okay. All right. So let us look at this question and then we can understand that appendix also. Supplier A Limited enters into a contract with a customer B Limited on 1st Jan 18 to deliver goods in exchange for total consideration of 50 million USD and receives an upfront payment of 20 million on this date. So this becomes an advance. The functional currency of the supplier is INR. Goods are delivered and revenue is recognized on 31st March 2018. 30 million is received on 1st April 2008 in full and final settlement. State the date of transaction for advance consideration and recognition of revenue. Also state the amount of revenue in INR to be recognized on the date of recognition of revenue. Exchange rates are 1st January 72 and 31st March 75 per USD respectively. Okay. So now, have you guys done Ind AS 115? Have you guys done Ind AS 115? Because for understanding this, we have a term known as revenue recognized at a single point with multiple payments. So Ind AS 115 speaks about revenue recognized over time versus revenue recognized at a single point in time. So this is a case where revenue is recognized at a single point in time. That means once you deliver the goods, you have fulfilled your obligations and you can recognize the revenue. You can recognize the revenue. Over a period of time means you meet certain conditions. Some 4 to 5 conditions are given. If you meet that, it will be known as revenue recognized over time. So now what the entity will do is it is receiving 20 million US dollars advance. So you will recognize a non-monetary contract liability amounting to 1,440 million. That is 20 into 72. So bank account debit to advance from customer's account 1,440. A Limited will recognize revenue on 31st March 18, the date when you actually transfer the goods. Determines that the rate of transaction for revenue relating to advance consideration is 1st January 2018. Okay. The date of the transaction for revenue relating to advance consideration of 20 million is 1st January 18. Determines that the date of transaction for remainder of the revenue is 31st March 18. On 31st March 18, de-recognize the non-monetary contract because now you fulfilled the obligation. Recognize $20 million revenue using exchange rate of 1st Jan. That is 72 per USD, and for 30 million using the exchange rate on 31st March 18, that is 75. The receivable of 30 million is a monetary item, so it should be translated. So I got 20 million. The revenue which I recognize in the future will be based on this exchange rate. Okay. As far as 30 million is there on that date, what is the rate? I will take that as the revenue. And finally, I will restate the closing rate, debtors, whatever is there. Okay. So bank account debit to advance from customers 1,440. On 31st March, I will have a debtor of 30 million into this 75, so 2,250. Advance from customers is adjusted. Sales account is actually nothing but USD 20 million into 72. So that gives you 1,440 million. And this is USD 30 million into 75. So this is 2,250. So my revenue which I am recognizing will be based on two different exchange rates. First one is when I receive the amount. What was the exchange rate prevailing at that point of time? Why this kind of adjustment is being done? See, I cannot show that amount is receivable or payable from the customer because he has paid an advance of $20 million, which is towards a revenue of $20 million. So technically, I cannot have a liability or receivable on account of merely a rate change that happens in the future relating to a payment that I receive in advance. And therefore, whatever is advance received, to that extent, revenue also will be recognized. So the advance is nullified. Whatever is the balance revenue that I am recognizing, that balance will be based on the date of the transaction. That will be based on the date of the transaction. Okay. So now let us look at the theory. An entity pays or receives consideration in advance. So it will generally recognize a non-monetary asset or a non-monetary liability. We recognized a liability. On related asset, expense or income is the amount recognized applying the relevant standards. On recognition of related asset, expense or income, non-monetary asset or liability is derecognized. Okay. So if a customer pays consideration, entity has a right to an amount of consideration that is unconditional before the entity transfers the goods. Present the contract as a contract liability. We gave a liability of 1,440. On the date of transaction, the date of transaction for the purpose of determining the exchange rate is the date on which an entity initially recognizes the non-monetary asset. If there are multiple payments or receipts in advance, determine a date for each payment or receipt of advance consideration. So you will ultimately be taking the respective advance received dates as your revenue, Okay. So this appendix will not be considered for income tax or insurance contracts. Okay. So that takes care of appendix B. We did this question for our understanding. Okay. So all of it is done. I don't think I have skipped anything. We have been able to complete the entire standard well in time. Okay. Translation of foreign operations also is done. Yes. Everything is done. Okay. All right. So coming back, just a quick summary of what we have discussed. We discussed why this standard came into existence because of so many multinational entities, etc. Yes. So the objective is to prescribe how to record a foreign currency transaction, how to consolidate a foreign operation into that of the parent's books. Okay. The scope we have discussed, it does not cover items which are covered under other standards like 109 foreign currency derivatives. So those things are there in the exclusions list. Functional currency, we saw what it was. Yes, functional currency is that currency which drives the sales costs, etc., the currency of the primary economic environment in which the entity operates. This was a new concept, not there in the erstwhile AS 11. Presentation currency is the currency in which you report your numbers, and also we saw what is a foreign currency other than the functional currency. Foreign currency transactions, we saw they could be sale, purchase, loans, whatever. So you will have to ideally segregate them between monetary and non-monetary items. Monetary items will be translated at the closing rate of each reporting period, whereas non-monetary items, on the date of the transaction you will record them. If they undergo a fair valuation, the rate on the date of fair valuation will be considered for the translation. Okay, so that was all about foreign currency operations and translation thereof. You could be having certain foreign currency transactions. Now when we talk about operations, you could be having joint ventures, associates, subsidiaries, branches, etc. So when you have to consolidate these results, they are obviously having their TBs in a different currency altogether. So if I have to convert, I will convert using the closing rate for all assets and liabilities, regardless of whether they are monetary or non-monetary. Equity capital, if any, shall be converted at the rate on the date of acquisition. Same goes for pre-acquisition reserves. Post-acquisition reserves, on an average basis, you will recognize the what you can say, the amounts. So that will give rise to a difference which will be parked in something known as a foreign currency translation reserve, which will be reclassified to P&L in the event of disposal of the subsidiary or joint venture or whatever it is. Yes. So that takes care of the disposal of the, when you dispose of, you will reclassify it to the P&L. Changes in functional currency it's generally not it's a common feature. It's a very rare feature. If at all you have to change, you will give the effects to it prospectively. Change in presentation currency is going to be regarded as a change in accounting policy. You will be giving retrospective treatment. Treatment of advance paid or received. Well, the date I receive the advance, I'll treat it as a contract liability, and the date when I fulfill the revenue obligation towards that, I will be taking that same amount as the revenue for arising for that period. Yes, so that takes care of everything relating to Ind AS 21 in totality. Okay, we did a couple of questions on foreign currency transactions. We did questions on foreign operations, disposal of foreign operations, as well as consolidation. Okay, so that should make you well equipped for your examination as far as Ind AS 21 is concerned. Anybody has any doubts? Okay, there was a doubt by Sanjay Pal. He had asked me the question on page 10.105. 105. Okay, so the entry here, one second. Profit debit and bank credit. How is that possible? Okay, so now two questions were there. Okay, so one is Sanjay Pal's question. Creditor account, bank is not transferring the money to the P&L. Where is the bank transferring? That is a balancing figure. Okay, that is a balancing figure. See, you had your trade receivables appearing at, okay, so he is asking this question. Okay, so the question that he is asking is what is the meaning of this 10,000 and then creditors debit by 3,25,000 and bank credit 3,35,000. See, you have stated your creditors at 65. You have stated your creditors at 65. But when you go to the bank, they are saying you will not have to pay 65. The exchange rate is 67. So that is why you have to pay 67. You have no choice. So the difference between 67 and 65, 2 rupees per US dollar is the extra amount which you are paying. So 2 into 5,000, that 10,000 represents extra payment which you are making. So we call this as a Forex gain or loss. We call this as a Forex gain or loss. The bank is not paying into the P&L. This is the extra amount which you have recognized as a loss. You had a liability of 325. You are settling it by paying 335. So this is a balancing figure, which is a loss of 10,000. Okay. You can also take it as the way you have told, P&L account debit to creditors 10,000, and you can take it as creditors to bank 3,35,000. That is also perfectly fine. No problem. Okay, both. I mean, this treatment also is fine. What you have suggested also is fine. What you have suggested is splitting up this entry into two parts. That's it. Okay, so that is also fine. You can go ahead. Okay, so that is Sanjay's question. Okay, now Viraj Desai had asked a question. After selling 70% of its investment, in example 3. Okay. Example 3. One second. When I look at example 3, owns 100% and sells 70%. The remaining 30%, it is a minority shareholder. It could be an asset. It could be a joint venture or an associate, depending on whether there is a significant influence or not. But for sure, it will not be a subsidiary as there is no control. So entire FCTR has to be derecognized. Okay, so that takes care of Viraj's question. Soham, common control, I think we had not completed. It was pending. It's an easy chapter actually. It's basically the pooling of interest method that you are having. Okay. So all assets, liabilities, reserves are taken over at book values. Goodwill cannot be recognized in a common control combination. Everything will go under capital reserve, whether it is a credit balance or a debit balance. So this was only what was there in common control combination. You can go through that. I will see if possible. I will ask them to replay the there was one video which we had recorded in the last batch or the batch before that. So we can have a recording of that for understanding your CCC. Okay, but it's very simple. If you've understood 103 CCC is even more simpler than that. Okay, so that takes care of our session on Ind AS 21. I don't think you have any other doubts. Please confirm it's all clear. Rashmi, Ankur, Sumit Jain, Soham, Shailendra, Saksham, Viraj Desai. Yes. Neetu Jain, to see the recorded lectures, it's available on YouTube, right? So in that sense, there is nothing no reason why you cannot see that. Okay. All right. All clear. Okay, fine. So we meet up on Tuesday. Try to do this standard by yourself. Ensure that it's completed. So we meet on Tuesday morning for Ind AS 12, I think, on income taxes. Okay. So once that is done, we are complete with Ind AS 12 also. Then एक छोटा सा class है CSR का, and then I think my side the portion is done. Okay. Thank you everyone and see you on Tuesday. See you guys on Tuesday. Yes. Okay. So yes. Okay. Session is done.